Okay. So again, good evening. We are going to look at capital allowances, and to cover this particular topic in taxation, I have the following course outline or the presentation outline. I want to introduce to a certain presentation outline, and saying that on completion of this particular session, you will be able to look at a position where you're able to define plant machinery for capital allowance purposes, compute income tax values or written down values, compute balancing allowance and charges, explain the treatment of motor cars, define industrial building for industrial building allowance purposes, define commercial building for commercial building allowance purposes. So that's what we are going to cover under this particular topic of capital allowance. Okay, so now we can say that in general, a general rule for computing income or profit of a business or trade, there are deductions that can be made either for capital expenditure incurred or for depreciation of assets acquired by such capital expenditure. Now, when you look at the treatment of depreciation in the income statement, you'd find depreciation will be charged in the income statement, and the effect it's going to have is that it's going to increase the total of expenses, which is going to be an amount deducted from the total income or gross profit. Total income or gross profit will be reduced by the total expenses. So that will result in what we are going to have as a net result, the bottom line of an income statement, the profit or a loss. Now, what you should understand is that if the total expenses is increased by a large amount, it means that the net profit will also be reduced by a large amount. So because companies do make an estimate, okay, of how they are going to use up the value of non-current assets, in this particular case we are talking about the capital items. So depending on what they are going to subject that particular asset to, you find that there are varied rates that can be applied. Now, if there are varied rates that can be applied, what will happen is that there could be undue advantage gained by some entities, in the sense that they are going to charge a bigger depreciation amount, therefore reduce the total income by a bigger amount, hence remain with a small amount of net profit and therefore pay less tax. For those that are going to underestimate the depreciation for one reason or another, or charge a smaller depreciation amount, they are going to end up with a bigger net profit reported, hence pay more tax. So this disparity has been realized or identified by the Revenue Authority, and to that effect what they do is they disallow depreciation, meaning that depreciation in computation of income tax is a disallowable expense to even out these discrepancies. But if your taxpayer is made to lose because there is this expense that has been disallowed, then what are you going to cover it for? Instead, the Revenue Authority replaces depreciation with capital allowances. So capital allowances are a form of a relief to a taxpayer. So when you talk about the relief to a taxpayer, we mean anything that is going to reduce the tax liability or the tax burden that is taken to be a relief. One of them is capital allowances, because they reduce the taxable profit. Okay, so that's what we are looking at as capital allowances. Now, under capital allowances, we have a number of capital expenditures that are qualifying expenditure for capital allowances. These include implements, plant and machinery, We have also industrial building expenditure, capital expenditure. We have also commercial building capital expenditure. We can also have farm works and farm improvements expenditure on that nature. That leads us to identifying what we call as capital allowances. So capital allowances are covered under 3 categories: implements, plant and machinery, industrial building, and commercial building. So who is eligible for capital allowances? Okay, so I've covered this aspect to say only those who are spending on qualifying expenditure or certain fixed assets qualify for these capital allowances. Okay, I've explained how these capital allowances are a relief to a taxpayer. They reduce the taxable profit. Okay, they reduce the taxable profit. So now, in the meantime, we need to understand that there are certain tax rates that are applied when it comes to calculating capital allowances. There are certain rates that are applied when calculating capital allowances. For instance, when you talk about industrial building, you can compute 10% capital allowance on qualifying expenditure. There is also wear and tear allowance for industrial building, okay, even including low-cost housing. For low-cost housing, these are structures whose cost of building is described in the Income Tax Act as that which is 20,000 kwacha and below. Those are taken to be low-cost housing. And these low-cost housing are dwelling houses for those who are employees of a particular entity to qualify. Okay, so we also have improvement allowance in form of commercial and industrial building. That is can be 100% if it is a farming activity. Wear and tear allowance for industrial building is 5%. Investment allowance is given to a taxpayer in the first year of manufacturing at 10%. Wear and tear allowance for commercial building is at 2%. Okay. Now, we have specifically, generally, the rates for capital allowances given as for wear and tear allowance, which is for implements, plant and machinery, it is at 25% generally. We have also got to get used to wear and tear allowance for non-commercial vehicles, which is 20%. When we talk about non-commercial vehicles, okay, you notice that under wear and tear allowance, we have a 25% rate for commercial vehicles. So commercial vehicles are those that are used to do business, like buses or trucks or tipper trucks or vans. Those are taken to be commercial vehicles. Non-commercial vehicles are normally those vehicles that are used for just maybe personal driving, luxury cars in form of saloon cars. Okay, those are non-commercial vehicles that are not normally intended for business. Now, even what is taken to be ordinarily non-commercial vehicle, if you notice that particular vehicle is used for business in form of a taxi, then it ceases to be non-commercial vehicle but commercial vehicle, and the rate which will apply will be 25%. So that's what we do. Okay, so implements, plant and machinery, the rate for those which relate to manufacturing, tourism and leasing, it is 50%. Okay, that for farm improvements, that is 100%. Here you see that the government, for instance, wants to encourage people to go into farming. Okay, so it provides a form of incentive by giving them the capital expenditure on farm improvements to be capital allowances to have 100% rate applicable. Even farm works, it's 100%. Development allowance is 10%. Farming implements is 100%. So these are some of the benefits that you see accruing to a taxpayer. Okay, so capital allowances for machinery is what we are going to start with and see how we can work out these capital allowances. Capital allowances on implements, plant and machinery. So we need to understand, for the purpose of taxation, what do we mean by plant? Okay, what do we mean by plant? It is good to note that there is no definition of plant in the Act. The general guidance, however, is given to distinguish between the setting in which the business is carried on and the apparatus which is used to carry on the business. Okay, for instance, when you look at maybe, let's say, a hammer mill. A hammer mill can be housed in a building. Okay, so the hammer mill can be used to maybe produce flour, okay, or feed for animals. Now, the hammer mill in that case will be used as a means to produce that particular flour. It's the apparatus to produce that flour. So the hammer mill will be taken to be a plant. But when it comes to the building which houses that particular hammer mill, that is the setting in which that business is carried out. It's not plant. So in that particular regard, land, building and structures cannot be plant. Okay, so with so many court cases that have been appeared, especially in tax, okay, over what is described as plant, so the precedence has been set. Okay, some decisions have been made in court which have been used as a principle to guide us on what is plant and what is not plant. In this regard, there is a test which is normally used. The test is a functional one. Okay, it asks, is the item simply part of the setting or premises in which the trade is carried on, or is it something with which the trade is carried on? So that is what helps us to decide whether something is a plant or not a plant. Now, let's look at principles applied in order to establish whether the asset or an asset qualifies as a plant. There are certain points that need to be noted. Okay, these include: take note that the words implements, plant and machinery must be given the meaning. Must be given meaning. So when you talk about implements, you're talking about normally tools that are used in carrying out a task. Okay, a plant, as I've mentioned, it is used to produce something. A machinery is normally referred to mechanical pieces of equipment, okay, to carry out the task. So that includes motor vehicles and machinery. It also includes things like hammer mill, as I've talked about. That is also machinery. Okay. We look at equipment. This is part of the plant. Equipment used in business will generally qualify as plant, provided that it is got some degree of durability. Okay, so it's not a once-off type of setting or apparatus that is going to be used in production. It has that kind of permanence, duration of permanence is guaranteed. So then that can qualify as a plant. We have also mentioned that plant cannot include the setting in which the business is carried out, as already mentioned. That is a particular feature that will help us to determine whether it's a plant or not. And then you have to understand that exceptionally, a building or structure may be plant, okay, if it performs an operational function of the business. Okay, if it performs an operational function of a business, so that can be a plant. Okay, Again, the exceptionally item will be a deco, maybe plant if the facts show that they create the atmosphere in which the important function of the particular trade was carried out. So the last one I can refer to a situation whereby you are looking at a solicitor. Normally you find that the solicitors or the lawyers, in their offices you see a display of quite a number of case books on the shelves, because a lawyer cannot work without looking at those particular books, or is deriving information from those books to discharge his duties. It is now used as an apparatus to perform his tasks. So that bookshelf will be taken to be a plant in this particular profession. So that's where you have some of the exceptions. Now, you notice that based on the above guidance, okay, then we can say that items that qualify as plant include general plant and machinery, fixtures, fittings, and furniture, motor vehicles, including fire safety expenditure, provided that it does not form part of a structure. So that's a qualification that you need to look at. Now, having looked at that, let's look at a simple example to illustrate how we come up with the capital allowances. As I said, we are going to start with first looking at implements, plant and machinery. That's a first core. Okay, we are going to look at implements, plant and machinery. So here we have a simple example. We have Mr. Mutwewankoko has acquired the following assets since commencement of his business. So we are given the assets involved. We have on 1st February 2021 a Toyota car.
Sorry, sir.
Yes,
Sorry,
please.
sir. Are you using the slide? I can't see the. Oh, you are just.
Okay, let me
I can't
just.
see the.
Okay, let me just reconstruct that one. I think you have just lost it. Okay. Are you able to see?
Yes, sir. I'm able to see now.
Okay, fine. So I'm looking at this particular example. Okay, we have Mr. Mutwewankoko has acquired the following assets since the commencement of his business. So normally an exam type of question will give you the assets involved, their accompanying or coupled with their costs, and when they were purchased, so that you can use those particular dates or timings to know which charge or which tax year they relate to. So here we have 1st February 2021 Toyota car 17,500. We have 1st March 2021 equipment 12,000. We have on 31st October 2021 a Tata truck 45,000, and on 1st January 2022 furniture 11,000. That's what we have. Now, the question tells us, or the scenario is telling us that all of the above assets were used exclusively in business. This Mr. Mutwewankoko business does not include any aspect of manufacturing. Now, when you look at this presentation of a question, a number of things need to be noted. One, there is an emphasis to say all the above assets were used exclusively in business. The reason why that statement is important is that where you see that the asset used partially for business, partially for private purposes, then you only claim the business proportion in terms of capital allowances. Okay? Again, in this particular question, we are drawn to the fact that This business does not include any aspect of manufacturing. The importance of that statement is that it's reminding you that you need to use an appropriate rate for capital allowances. For those in manufacturing, the implements, plant and machinery, the capital allowances are at 50%. So for those others, the implements, plant and machinery, as we have seen, the implements, plant and machinery for others is at 25%. So the examiner will be trying to signal to you that use an appropriate rate in this particular case. It's these particular implements, plant and machinery are not in manufacturing, but in the other sector. So which talks about 25% rate as opposed to 50%, which applies under manufacturing on implements, plant and machinery. So then, how do we go about the computation? A few things need to be noted here. Okay, again, you should know that capital allowances are calculated in the year of acquisition and not in the year of disposal. So regardless of when you bought the asset, the full year's capital allowance will be claimed. But in the year when you dispose of the asset, you cannot claim allowance on the asset disposed. Okay? So that's what is important there. I need to talk about also the qualifying period. Okay? The emphasis is that each item of qualifying expenditure qualifies individually. Okay, so what does this mean? It simply means that even when you have a number of motor vehicles, when coming to calculate capital allowances, there's no way you can aggregate the value of these motor vehicles and do one calculation. Each motor vehicle will be treated and capital allowance for that motor vehicle will be done separately. Okay, separately. So that's the emphasis there. Again, the other important thing that you need to take note of is if the accounting period is less than 12 months, then the capital allowance, okay, should be scaled down proportionately. Let's say if the accounting period is for 8 months, now those rates are for 1 year. It means that when you calculate the capital allowance, you need to scale down by multiplying 8 out of 12 so that you look at the capital allowance which will be appropriate for those 8 months. Now don't confuse this with the aspect of capital allowances being claimed in full, regardless of when you acquired them. In acquisition of an asset, it doesn't matter what time you're acquiring the asset in a particular charge year, the full capital allowance will be claimed. But here, what I'm talking about is that where the period of account is less than 12 months, then the capital allowance which has been calculated should be scaled down to the proportionate number of months value. Okay, so now how do we go about this computation? How do we go about this particular computation? Okay, I have this one for 17,500. And we also have equipment for 12,000. Let me see if for 12,000. So how do we go about this calculation? So that's what I'm going to show you. Okay, so let's look at this one. So in this particular example, you notice that we are in 2021, there were 3 transactions. On 1st February 2021, there was acquisition of a Toyota car. On 1st March 2021, there was acquisition of equipment. On 31st October 2021, there was acquisition of Tata truck. Now, all these are under implements, plant and machinery. For a Toyota car, this is not, since the car, unless we have been given information to the contrary, it simply means that this one is a non-commercial vehicle. Unless we have been given information to the contrary, we take it that it's used by this individual just to make personal errands. Okay? Equipment is under implements and plant and machinery. Then when you look at the Tata truck, this is machinery, but is normally a Tata truck will be used for hiring or carrying goods for the business. So it is taken to be a commercial vehicle. So Toyota car compared to Tata truck, Toyota car will be attracting a capital allowance of 20% because that is the rate for non-commercial vehicle. Whereas Tata truck will attract a capital allowance rate of 25% together with equipment and also furniture. So how do we do that? How do we calculate that one? So that's what I'm going to show you in this particular case. So as I said before, you look at every asset, this qualifying asset, to be calculated separately for capital allowances, to be handled separately for capital allowances. So that's what we are going to do. Okay. So we are going to show that the first one is computation of capital allowances. For charge year 2021. That's the first one that we have. Just reduce this one. Okay. So we have the cost, you can have capital allowance. Cost and capital allowance. We have put the kwacha symbol there. You can remove this is excess. Okay. So we are seeing that we have the 1st February a Toyota car. So as I said, each asset will be taken separately. So you are going to indicate that we are dealing with Toyota car. Okay, you can underline that one, and then under Toyota car is the purchase cost. Now the purchase cost, on the purchase cost, if you look at this particular example, it is 17,500. That's what you indicate here, 17,500. Okay, so that's what we have there. Then it's supposed to be subject to wear and tear allowance with the capital allowance. So wear and tear allowance. Okay, remove this one. Okay, and tear allowance at. Since the motor car, it's non-commercial, the rate is 20%. So 20%, the wear and tear allowance is always calculated on the original cost. The wear and tear allowance is always calculated on the original cost. Don't forget, the wear and tear allowance is always calculated on the original cost. So the original cost is 17,500. If you work out the cost, look at my calculator. Okay, so 20%, 12.20 multiplied by 17,500. We're going to end up with 3,500. So we put here 3,500. Okay, so 3,500. So indicate that we have registered that one, 3,500. This one. Okay. There we are. Let's add some row below. Okay. So now what we have, so when you remove this 3,500, you are going to remain with 14,000. So we show that here we are going to remain with 14,000. So this 14,000 is what we call written down value. Written down value. Okay, written down value. So that is for the car. That is for the car. Now we go and look at the computation for another one, because this in 2021 it was not only a Toyota car, there was another one, another acquisition. So look at that one. Let's calculate it separately. Again, we have 4. Okay. Now this one is involving, look at in 2021 we had equipment. Equipment was at 12,000. So look at equipment. So again, you come and itemize it. Now we are dealing with equipment. Okay. Okay, move this one. Okay. Have equipment. Again, we have monetary values. Put it on the board. also underline. And under equipment, we have purchase cost. Purchase cost. How much did we buy the equipment at? How much was the equipment at? So if we go back to the question, 12,000. Yes, 12,000. Yes. So we're going to put that value here. Purchase cost 12,000. Okay. Again, this is subject to capital allowance, which we call wear and tear. Okay. Wear and tear allowance. Wear and tear allowance at equipment, it's at 25%. So 25% of 12,000 will be 3,000. So I have that one, 3,000. Okay, so we register that one under, include this one, just want to make sure that and set a row below. And we took this one. Okay. Here we did from cost, and here we leave it for capital allowance. Okay, so under capital allowance we register 3,000. Okay, so now with that, it means that we have to reduce it by 3,000 so that we have 9,000 remaining. Okay, that is taken to be written down value, WDV. Okay, written down value. So that is during 2021, okay, when we have this. Another one, under 2021, that what happened? We go back, we find that we had another transaction, Tata Track. So in a similar manner, you come, okay, open. And that is now Tata Track. Okay, so we also underlined. Okay. So here we have the cost and we have the capital allowance, and show that they are in kwacha. So we start with purchase cost. So that is what we bought the asset at. The Tata Track is 45,000. 5,000. Let me add another. We also remove the wear and tear allowance. Wear and tear allowance. Tata truck, it is at 25%. So 25%, since a commercial vehicle. So come here, what is 25%? So 25% of 45,000.
11,250.
Okay, that is a 0.25. Indeed, you get 11,250. So we pick it, put it here. 11,250. So we register that is the capital allowance, 11,250. So after I write down that initial capital by that, what are we going to remain with as a difference?
33,750.
33,750. Like that. Okay. Again, this is the written down value. Okay. Okay. Written down value. Carried down. Normally we put carried down. Okay. Carried down. Like that. Okay. Adjust this. Okay. That manner. Okay. So we have this one for Tata truck. We have equipment shown there. Here again, it's carried down. Okay, just to make it a bit neat. Okay, fine. So that's what we have. Okay, so that tells us how we're supposed to calculate the capital allowances for the first year, that is 2021. We have those three assets taken on board. You see that down? Okay, so that is for the first year. In the year of acquisition 2021, we have calculated capital allowances and we have seen the written down values. Okay, so now comes 2022. Now as we go to 2022, remember we still have these assets with us, so we still have to calculate. They have entered the 2022, so we have to still deal with them. So we get back to them again. So we start with the motor car. So now we are dealing with which period? A charge year 2022. Charge year 2022. That's what we have. Okay. So now use this. Set row below. Set another row below. Okay. Trying to make it a bit smaller. Looking for this one. Okay. Okay, fine. So we're looking at this one was charge year 2021. Okay. Let's say this one. Remove it from there. Okay, charge year 2021. What we start with? Written down value brought forward. Remember this one, written down value carried down, but is brought forward. So we say written down value brought forward. Okay, brought forward with how much? 14,000. Okay, 14,000 in written down value brought forward. So you have 14,000. What we do? We again calculate the wear and tear. We calculate the wear and tear allowance here. Wear and tear allowance. Again, at this is a motor car, so it's at 20%. It's a non-commercial vehicle. So 20%, the capital allowance is not calculated on written down value, it's calculated on the original cost. The original cost is 17,500, so means that we are going to still have 3,500. Okay, that's wear and tear. So ending up with, remove that one, we're going to have 10,500. And register that, we have capital allowance of 3,500. So show that there is a subtraction there. See that, huh? So this becomes the written down value carried forward. Carried forward to next charge year. Okay, so that is for Toyota car. So now again we have the other assets still with us. Look at this. We are the equipment as well. So you need to look at what we do with equipment. Okay, what we do with equipment. So this one was charge year 2021. Charge year 2021. Okay, you can put this one. Board 2021. So we want to add some more. Okay, so now we are in charge year 2022. Charge year 2022. What happens? We bring down the value, written down value, brought forward or carried down. Okay, we have the 9,000. Okay, then we charge wear and tear again for this one. Again, remember, wear and tear allowance or capital allowance is charged on the original cost. The original cost for this equipment is 12,000. You don't apply it on the reduced balance 9,000. You always use the original value, which is 12,000 original cost, wear and tear at, this is the equipment, it's at 25%. So 20% or 25% of original cost is still 3,000. Okay, so when you remove that, you are going to end up with 6,000. You are going to end up with 6,000. So we register that you have to claim this allowance. There we are. We have this particular amount, which is written down value, carried forward, okay, so that's how we do it, carried forward. For equipment, we have that one, okay, just to make it more smart, put it that way, put it this way, okay, that way, okay. So we have registered that. Then we also move to look at the other asset. Remember, we had a Tata truck as well. So Tata truck has crossed into 2022. Also look at what we do with the Tata truck. So again, okay, there you are. This is charge here, 2021, but we are going to charge here 2022, and therefore we bring down the value, written down value, brought forward, which is 33,750 as the opening balance. Okay, again, this is the new year. So we charge it with, again, capital allowance. It's claimable. Wear and tear allowance. At 25%, it's a commercial vehicle. Of the original cost, means that we are going to charge 11,250. So this is, we are deducting from there. So we register that we have again claimed 11,250 as capital allowance. And what do we remain with? We remain with, if you deduct, you're going to have 22,500 as written down value, carried forward. Okay, so we can make it a bit look nice. Okay, carried forward, Okay, make this one be bold. Okay, there we are. So that's how the Tata Truck capital allowances computation look like. Okay, now we are in 2022. Remember that in 2022, particularly January, we bought some furniture. So this is an additional capital expenditure furniture which falls under implements, plant and machinery. So we are going to show how we calculate this particular capital for this particular implement, plant and machinery. So let's look at how we go about this one. Okay. So this one came in the charge year 2022 charge year. Okay, that's what we have, and we have the cost, and we have capital allowance, the kwacha, okay. Have it here. Okay. Okay, something like that. So again, what asset we have here? We have furniture. We made the capital expenditure on furniture. Okay. Then we have, since the first year, we have purchase costs. Okay. What's the value? It is 11,000. So run with it. 11,000. Okay. Okay. What is the wear and tear allowance? These ventures, implement, plant and machineries. So wear and tear. Allowance. It is at 25% of the original cost. So when you calculate 25% of this one, what do you get?
It's 2,750.
2,750. So we come with it. So it's a capital allowance 2,750. So again, remove it and the register that we have claimed 2,750. So what we remain with? We remove that one. What are we going to remain with? The difference
8,250.
8,250. So this is written down value which will be carried forward. Carried forward. Okay. So that's what we have in terms of that particular question. Okay. So that's how we go about calculating these capital allowances where you are dealing with implements, plant and machinery. Okay. So what have we learned? We have learned that you should be able to distinguish for motor vehicles that which is a commercial motor vehicle and that which is a non-commercial vehicle, because the allowance rates that apply are different. For commercial vehicle, implements, plant and machinery, 25% capital allowance, wear and tear allowance. For non-commercial vehicle, it's 20%. Like a saloon car, that is a non-commercial vehicle. However, I've mentioned that even when a car is normally used as a non-commercial vehicle, look at what it is applied for. What is it used for? If it is used as a taxi, then it ceases to be non-commercial vehicle, but becomes a commercial. Equally, the rate also changes in that case from 20% to 25%. What we have also learned is that you need to look at these qualifying expenditure for capital allowance purposes to be calculated separate. They are never aggregated. You can see motor vehicles, all these are implemented. There is no way where you can aggregate the values and then calculate one value for capital allowance. No, you have to handle them separate, one by one. So that's what we have demonstrated. Are we clear on this one? Are we clear on this one? Okay.
Clear, sir.
Okay, fine. So not to belabor you too much, so I want to take you bit by bit. So the next time we're going to meet, we're going to look at implements, plant and machinery, but look at it from a situation where we have divided use. In this particular example, we have assumed that these assets were used exclusively for business, but there are certain instances where you use an asset for both business and private use. So that's what we're going to see later on. Are we together? So
yes, sir.
Be tuned in next time to look at this particular presentation on capital allowances.